The loan officer leans back in his chair and asks a simple question. How much do you need? Across the desk sits a young entrepreneur, a new cafe, a small building renovation. $50,000 would change everything. The paperwork is routine, a signature here, a credit check, a risk assessment, and then something remarkable happens. The bank approves the loan. But the money does not come from a vault. No armored truck arrives. No pile of cash is counted from deposits stored in the basement. Instead, a clerk types numbers into a computer. A balance appears in the borrower's account. $50,000. In that instant, the bank has created new money. Not transferred, not borrowed from someone else, created legally. According to the Bank of England's 2014 report, money creation in the modern economy, this is not a rare event. It is the primary way money enters the economy. Roughly 90 to 95% of money in modern economies is created by commercial banks through lending, which raises a disturbing and fascinating question. If banks can create money simply by issuing loans, who actually controls the supply of money in the economy? Because the answer reveals something deeper than banking. It reveals the hidden architecture of the modern financial system. To understand it, we begin centuries before computers or digital accounts in a far simpler world where money was heavy, physical, and painfully scarce. Early banks emerge as goldsmiths in 17th century Europe. Merchants deposit gold coins for safekeeping, receiving paper receipts in return. And these receipts begin circulating as money themselves. It is easier to pass paper than metal. At first, every receipt is fully backed by gold sitting in the vault. But goldsmiths notice something. Most depositors never withdraw their gold at the same time. The coins simply sit there, idle. So the goldsmiths begin lending some of that gold to borrowers while still honoring the paper receipts already circulating. Suddenly, two claims exist on the same pile of metal. The depositor S receipt and the borrower S loan. This is the birth of fractional reserve banking. And with it, the first glimpse of a strange financial power. Money expanding beyond the physical assets backing it. The logic seems simple. If a bank holds $100 in deposits and keeps only $10 in reserve, it can lend $90. That loan eventually becomes someone else's deposit, which can be lent again. The process multiplies money throughout the economy. For centuries, textbooks describe the system using a tidy formula called the money multiplier. But modern banking no longer works quite that way. Today, the mechanism is both simpler and more unsettling. Imagine a whiteboard. Step 1. A bank approves a $10,000 loan to a customer. Instead of transferring existing funds, the bank simultaneously creates two entries on its balance sheet. On the asset side, loan, $10,000. On the liability side, deposit, $10,000. The loan is an asset because the borrower must repay it. The deposit is a liability because the bank owes that money to the customer. Both appear instantly. Money has been created through accounting. This process is confirmed not only by the Bank of England, but also by research from economists at the International Monetary Fund, including Michael Kumhoff and Zoltan Jakob. Their 2015 paper describes banks as institutions that create deposits when they lend, rather than intermediaries that lend existing deposits. In other words, banks are not merely moving money, they are manufacturing it. At first, this system appears elegant. Credit fuels investment, businesses expand, homes are built, economic growth accelerates, debt becomes the engine of prosperity. But embedded inside the system is a profound paradox. Every dollar created by banks enters the economy as debt, and debt carries interest. If banks create $1 million through loans, borrowers must repay more than $1 million over time. The additional money required to pay interest must come from new loans elsewhere in the system, which means the system quietly depends on continuous expansion of credit. The machine must keep creating money, or it begins to seize. This hidden fragility becomes visible during financial crises. Consider the global financial system in 2008. For years, banks aggressively expand mortgage lending. Each new home loan creates new deposits, which inflate housing prices. Rising prices justify even larger loans. Credit expands in a feedback loop. Then defaults begin. As mortgages collapse, bank assets suddenly lose value. Lending freezes. And when lending stops, the creation of new money stops with it. Economist Richard Werner, who first coined the term quantitative easing, describes this moment bluntly. Modern economies are not primarily constrained by physical resources or labor. They are constrained by bank credit creation. When banks stop lending, the money supply contracts, and recessions follow. Governments and central banks respond by injecting liquidity into the system. Programs like quantitative easing allow central banks to purchase financial assets and stabilize banks' balance sheets. But even these extraordinary interventions rarely bypass commercial banks entirely, because the core mechanism of money creation still lives inside them. This brings us to the modern landscape. Today, the same credit creation engine drives everything from housing markets to private equity acquisitions. Leveraged buyouts depend on bank credit. Corporate debt markets depend on it. Even speculative bubbles, from tech stocks to crypto, often trace back to abundant lending conditions. The plumbing remains the same. Loans create deposits. Deposits become purchasing power. Purchasing power inflates asset prices. Understanding this mechanism offers a powerful framework for reading financial headlines. When analyzing any economic boom or crisis, 3 questions matter. First, who is creating credit? Banks, shadow lenders, or capital markets? Second, where is that credit flowing? Productive investment or asset speculation? Third, what happens if credit suddenly stops expanding? These questions reveal whether a financial system is building sustainable growth or quietly inflating a fragile bubble, which brings us back to that loan officer approving the cafe loan. He did not transfer someone else's savings. He expanded the money supply with a keystroke. The borrower receives opportunity. The bank receives an asset that generates interest for years, and the economy gains new spending power. But the system also gains something else, another layer of debt that must eventually be repaid. So banks do not simply store money. They design its creation. Understanding this is not about predicting the next financial crisis. It is about seeing the invisible infrastructure beneath the economy, the pipes through which credit flows, the valves that control it, and the pressure that builds when the system expands too quickly. Because once you understand how banks create money, the financial world looks very different. It stops looking like a marketplace of existing wealth and starts looking like a constantly expanding ledger.